Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today. Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com and to our Outlook 2022. The Tipping Point, our series continues with more incredible guests. And joining me today is a man who's known as being the contrarian's contrarian, and he does not come with very good news for 2022, saying that we will experience the biggest stock market crash of our lifetime. Please welcome back to the show, Harry Dent. He is the founder of HS Dent. He's also the editor of HS Dent Forecast. Harry, good to see you again. Welcome back.
Yeah, nice to be back.
We got a lot of ground to cover, and you know where I'm going to go first. You don't come with a lot of good news for 2022, saying that we will see the biggest stock market crash of our lifetime. We're going to talk cryptos. You also don't have good news for the crypto space. But first, the stock market. Harry, my question to you is, look, you've been calling for this crash for quite a long time. In 2021, you were looking for it to happen in April, then in June. So I have to start with this. You've been wrong on those calls. Why are you certain now?
Okay, it's as simple as this. We're in what I call the orgasmic phase of this bubble. It's just been building and building. People have to realize since 2007, and I call that one 20 years before it happened, late 2007, baby boomers peaked in their spending. We had a peak in the stock market in late 2007, and we went into the first deep recession since the early 80s and the early 30s, okay, the Great Depression. And that's when the Federal Reserve and central bank just went nuts. We have printed more money in the last year and a half or so than all of the printing before this, and even since 2008 and 9. I mean, just years and years of this. So they keep doing exponentially more. So they're just desperately keeping this bubble going. And when you get in this phase, there's no way to say, oh, it's going to happen this day or this month. I mean, I was able to predict the 2007 top because I could precisely determine within several months when the baby boomer was going to peak and momentum was going to turn down. But this is just a bubble's going to go until it bursts. I'm now looking literally at chart patterns and things like that to see when this bubble looks like it's going to pop. And this looks like one of the times right here in December where it could top. If not that, it'll be early next year. After that, I'm going to be shocked if we do not see a downturn. So it's at the point where, to me, this is such an extreme bubble. If you're hanging in there to say, well, maybe it goes another 3 or 4 or 5 months, I'm like, get out. What my research does show 100% is that when a bubble like this bursts, you're going to see 40 to 50% crash in the first 2.5 months. And if you sit and wait for that, it'll happen before you're ready. And then you'll panic when that happens, and then it'll bounce, and then you'll look like a double idiot. So this is very tricky. And I think Baron Rothschild, the richest man of the 1800s in Europe, said, what is the secret to my success? I always got out a bit early. Okay, that's what I say. Be on the early side. And this is already way later than this thing should have gone. But the governments are exponentially selling more. Now, for the first time, with the economy only coming back in recent months, it was declining in the second, third quarter. Okay, after all that stimulus, it was declining. Well, it finally came back with this, recent stimulus. Okay, this has put them in a bind. They now have almost 7% inflation, and the next report's probably going to be higher in December. We're going to get that January 12th. And the economy has suddenly gotten strong. It was weak. Now, so they have to tighten. What I'm telling people, Daniela, when you have an economy that's now been stimulated for 12 years against fundamental demographics, against slowing even technology. All of my cycles are slowing at this point, and most of them for years. It will not take much to prick this bubble. That's what I'm saying. So just them saying we're going to have to taper and just starting, they're already cutting 30 billion a month in buying bonds, and they're supposed to finish tapering that and then raise interest rates by March. You're going to get a top in here by early next year. I say it looks like it's happening now. That's all. But I cannot be accurate at this stage on precisely when. You just
Okay.
can't.
So, and just to go back to the timing, I get it. I've said the same thing to Robert Kiyosaki. It's hard to stick your neck out with a certain call. But why do you think the mark was missed on your original forecast of April and June? What happened?
They just keep pumping it up, and the markets keep buying. I mean, at this stage, the market will only go down when something triggers that's big enough, or the last person gets in the stock market. And it's hard to tell which of those. But I think what typically happens, Danielle, and this has been every top in this boom since the early 80s, when the stocks markets go up for about a decade, they usually get pricked when the interest rates, inflation starts to rise late in the boom, and the bond rate, the bond rates go up. Now, the big thing right now, which is extremely unusual, we have 6.8% inflation and rising, and the 10-year Treasury bond is yielding 1.4%. That's like a negative yield of 6-7%. So that I think the Treasury bond if it keeps edging up, that could be the trigger, but we're just way beyond this thing.
Harry, let me ask you, because that is the concern, right? That when the Fed would start tightening, what impact would that have on the stock market? But the Fed knows this, right? So won't they do everything in their power to avoid a stock market correction? This is what they've been working so hard to avoid. They've been pumping. Why would they just put their guard down? Why would they have?
You got to remember, there's a lag to everything. Monetary policy lags about 18. Now it starts, but it lags about 18 months in its real effect. And so they've been forced to start to taper off. What I keep telling people, you got to understand addictions, you got to understand bubbles. They're both the same thing. Something blows up, it takes exponentially more to keep a bubble or an addiction going. And all it takes is just pulling back. You don't have to stop the stimulus, just less stimulus, and then no stimulus is all it takes at some point. So it's just a matter, and so now they're forced to get a little more tight. Well, if they're going to decide, if they pull back and immediately get easing quickly, it's going to look like they're panicking. So now that they're in a tightening mode slowly, it's going to take them a little while to respond and go the other way. And in that time, again, remember what I said at the beginning, 2 to 3 months. Every major bubble burst has happened within 3 years, and it's been from 42% to 50%. And my calculations on this one that's been so stretched is it's going to be 54% the first crash. If that first crash happens, if they just slip that long, people will lose confidence in this market. Imagine if the S&P dropped, 54% in 2 months. You think anybody believe, oh, well, they'll just print money again, it'll come back? You will not see the market come back if it crashes that much. I will almost guarantee you that.
Are there certain sectors that will be saved, or where do you see the ones getting hit hardest?
Well, yeah. Obviously, it's the small caps the small caps are about, if they break 2,100, that's going to be my first signal. This really is a top, and we're about 50 points from that today. Okay, a couple of percent. The small caps lead, and of course the tech stocks follow. Those will be the ones hit the most. If you get, healthcare and defensive nations and consumer staples, of course, those are going to hold up better. But in a stock crash like this, after a major bubble, everything will go down, including utilities. It's just those sectors will go down 40 or 50%, and then the leading sectors will go down 70, 80, 90. So that's the difference. There is no safe place to hide. The only place to hide, which was proven in 2008, and it wasn't gold. Gold went down 40, 50% in the worst of that crash. It was the US 10 and 30-year Treasury bonds and the US dollar that bounced in that crash in late 2008 when it was at its worst. That was the safe haven. That's what I'm telling people to do. Get in Treasury bonds. I'd even wait here to let inflation get a little higher, maybe wait until early January, then get in these Treasury bonds and just sit there, and whether the crash happens now or a couple months from now, when it does, it's going to come like a freight train. That's what history says.
two things I really want to bring up. You mentioned inflation. Let's go there first. I just had Jim Rickards on, who thinks we've already hit peak inflation. The worst is behind us. Of course, I've had other experts on who think it's just going to keep running. Where do you sit with it?
Well, I'm in between on that one. I have the best inflation indicator in the world, workforce growth. No economist would think about that. Incorporating young people into the workforce takes investment in computers and trainings and offices, all this sort of stuff. That's the biggest correlated with inflation over time. Inflation has been falling since 1980, right with my indicator. It should be 2% today. And what's it at? 6.8. We'll call that 4.8% inflation created entirely out of the recent stimulus. So that's what the stimulus has done. As soon as we have a slowdown in the economy or they stop stimulating, I agree, inflation's going to fall off. We could be at peak now or soon, would be my guess, more like with Jim Brigham. But it's going to take a drop in the economy to stop. If the economy does not slow down, we do not have this downturn, then inflation is likely to edge up at least for a little while. So, but inflation's already up way more than it should be because of stimulus. So, and the stimulus is no longer escalating. They're looking at tapering it. So I say, yeah, we're probably near peak inflation, and it should go down to zero or negative. And then when we come out of this downturn, you are not going to see inflation over a couple percent for the rest of my lifetime, and most of the people listening to this, almost guaranteed. Workforce growth is going to be damn near zero as we go into the future for the U.S. and Europe and Japan and the Eastern Asian countries developed are worse. So inflation is gone forever.
Stagflation?
Well, no. The 70s was stagflation because the baby boomers were entering the workforce. You have to remember, we weren't printing money in the 70s. We were running deficits, but governments are going to run deficits when costs are going up and you're having recessions. So from the late 60s to the early 80s, it was an inflationary, recessionary economy. That's called the summer season, okay? In my long-term thing. That's what you expect to happen. This is not that. This is temporary inflation that is not going to last past as soon as the economy slows down, and it's not going to come back when we get out of it. So you won't see inflation at 7% a couple years from now. Will not.
Will a recession be triggered?
Yeah, well, again, what tends to trigger recessions and stock market crashes after a really good boom like this is that inflation starts rising from overcapacity and overstimulation and all this stuff, and then that triggers slowing in the economy, that triggers stock markets to crash, and then that builds, and then that washes out inflation, brings high unemployment, lower spending, and that brings inflation down.
To this point, let's talk politics a second here. Joe Manchin, putting a dent, no pun intended, in Biden's Build Back Better plan. Your thoughts there?
Yeah, well, I mean, again, look at what I've got 4.9 trillion in monetary stimulus. Now they're talking trillions of dollars in infrastructure. This is the biggest overreaction in history. They've been stimulating now for a decade, 12 years, which would also tell you if an economy takes nonstop money printing and now endless fiscal stimulus just to grow at a couple percent, then the economy without it would be in a recession. So that should be obvious to people. People don't think that way. Why has the economy, see, when we came out of in late 2008, early 2009, they printed the first trillion. If that would have just been a normal little monetary correction, a little rebalancing, and it hadn't have been a big demographic downturn and all that sort of stuff, we would have come out of it. It wouldn't take 12 years of nonstop stimulus to keep a dead economy going. That's what we've been living in, a dead economy. When we have this recession, we will wipe out all the excess money and all the excess debt. That's what recessions do, make everything more productive. And by the time we get out of this recession, we will have fundamental uptrends again, because the millennial generation is going to have their boom from 2024 to 2037, something I've been predicting forever. That's right in the demographics. That's not something that changes. So we have to clear this out. Otherwise, we're dooming the baby boomers, are dooming the millennials with our debt bubble and our financial asset bubble, which are all have to get washed out because they're not real.
In your forecast, how much is the new variant weighing on the stock market correction? Did you calculate that into your forecast, Harry?
Well, again, that's another short-term thing, just like COVID. Yes, that I'd say that's one of the triggers that's hurting this endless stock market advancement with printing ever more money. Okay, but it's also the government and the Fed sees this and says, "Oh my God, we got through COVID. Now we got this new variant." So that's what's keeping them from saying, "Well, we were going to taper, but they're going to keep backpedaling here." But again, I'm just waiting for that first crash. The only thing you can do is that first crash, I say, will be so violent that people will finally get what they've already thought in the back of their head. Oh, you really can't live on just printing money. We've been living on printed money since late 2007 when we went to the 2008 downturn. Why? For very good reason, because the biggest generation in history finally peaked in spending, and the trends have been low since. We have been living 120% on money going in the economy, ultra low interest rates, a 10-year treasury bond of 1.4% with 7% inflation. You think we would have that without all this manipulation of money print? This is a totally artificial economy, which means when it blows, it's going to blow even harder. It's not even real.
I understand you don't want to pin yourself to another month, but if I had to say, when does the first tranche of the crash happen? Is it Q1, Q2, Q3? Any indication?
I think Q1 is I think between now and January is the most likely time for that. I think it may have peaked in November 22nd, okay? Because I've been tracing stock markets, different sectors here and around the world. Almost everything is already peaked except for the NASDAQ and the S&P. That's the only thing. Small caps are down 13, 14%. A lot of countries have been down for months. Emerging markets have been down for over a year. The bond market peaked a year and a half again, the corporate bond market. These are all leading indicators that say we're building towards a crash. And like I say, it's hard to predict. When does that happen? It's possible November 22nd was the peak. We could also get a peak sometime in the first quarter. I'd be extremely surprised at this point if we don't peak and get that first crash starting in the first quarter. If it goes past then, I'm just going to be like, I don't know what to say. I mean, literally, there's a point where you have to say, I don't know what to say, because this has never happened. No, governments have never fought a bubble like this, or boom, which they created. This bubble would not have happened without governments. The 2007 bubbles, those were more natural. This is totally artificial. So
you have said you would retire if the crash didn't happen.
I know. I am considering retiring. I wouldn't retire for my research, but I would consider saying, I don't know if I'm going to write a newsletter anymore. I'd have to go at least a year if I did that. But yeah, I have considered that. I've said if we can go all the way through the end of 2022 and not see this crash start, then I would say yes. I don't have much to say about the economy anymore. It's still a bubble, still got to blow, but then I have no idea if it can last that long. I say the odds are 90% it does not make it that long without this first crash setting in.
Let's talk more bad news before there is good news coming from Harry Dent. So stay tuned, folks. Hold on. Hold on. We'll get there. But first, cryptos. You actually think cryptos, should we have the stock market crash, will get hit even harder than the stocks?
Yes. And let me tell you something. That's a good sign. You know what I'm parroting the cryptos on today? On the .coms. Amazon came at the end of that bubble. That wasn't the bubble, the Amazon, the .com bubble. It was it was a broad internet and tech bubble. The .coms came in the last few years and started to roar, just like the cryptos here, the end of this bubble, and then burst. Amazon went down 95% and the internet index went down 96%. I call it the baby bubble. New sectors emerge. The smart people say, oh, this is the next big thing. And I am on that train. I am crypto. I call it PCs, internet, crypto. The three big stages of technology. This is the next big thing, but I've studied these big things. They have a baby bubble, the most extreme crash. Then they have the daddy bubble, okay? It lasts much longer. So I'm saying crypto will crash more than the stock market, 95, 96%, something like that. Stock market, 87%. And guess what will be the best buy out of this? I'm not going to buy AT&T or IBM. I'm going to buy freaking Bitcoin and Ethereum and Cardano, whoever, Solana, whoever survives this thing. There's 9,000 coins. Some people say there's 14,000. This is crazy. This is typical of a baby bubble.
You would step in and buy.
Oh, I'd say it'd be the buy of a lifetime, not just to buy this next crash, which will be the largest in our lifetime, if I'm right, but to particularly buy the crypto sector, because it is the leading edge, better than biotech, better than other sectors, and that's all part of it too. And nanotech, buy the crypto sector will be the best buy.
Because it would come back roaring in how long should a crash happen on the cryptos?
Yes. Okay. So they'll probably be the first to bottom, maybe, 2021, I mean, 22, it's the late 22 instead of 23 for most stocks. And I say the next boom will come from 2024 to 2036, 37. And that's right about parallel to a 20-year lag. The cryptos may go a little longer than that, but I call the crypto movement a 20-year lag on the internet. And the internet did the same thing. Remember, baby bubble crashed 96%. And then internet went up 600 times, 600 times in 12 years. That's what I'm talking about. So that's bullish. You couldn't get more bullish than that.
Help me understand this from an economist point of view. Okay, really help me here. Because I've heard this narrative before, the comparisons to .com, but they're not built the same way. So why is there this conviction that the cryptos will have the same historical patterns as the .com?
Okay. What the internet did in the .com, it allowed retail, it allowed information to become mass, accessible, and it allowed retail to expand online. Okay. What crypto does, what the next boom is crypto is the digitization. Here's the best definition in one sentence: the digitization of all financial assets and money. That's what this revolution. So the reason that it's the next big thing, if it was just internet 2, it wouldn't be another big thing. It is going to do what internet did for everything else, for the whole financial assets and money and wealth sector. So that's what's different about it. You got to be different to be the next big thing, but you have to build on the last big thing. So that's why I've been sold on crypto from the beginning. Once I heard a guy spoke at one of our conferences, Mark Yusko, and he gave that definition, and then I got it.
Yeah, I like Mark.
That's a big deal.
Yeah, I didn't think you'd buy or ever buy into crypto, so I'm interested to hear that.
Oh, absolutely. I'm saying that is the number one sector. I'm going to be saying whatever survives, and you have to look at what survives in a shakeout. Okay. General Motors basically came out of that shakeout and kicked Ford's ass, who came in leading. So something else but you see who shakes out and does the best and holds up the best and starts to lead. The crypto sector should be the number one high return sector to invest in coming out of this. And guess what? That's the opposite of what you'd expect, that it crashes the hardest. You buy whatever crashes the hardest, it still has the fundamentals. Because again, I'm putting it on a 20-year lag to the internet stock. So if you'd have bought Amazon, I'm saying buying crypto in 2023 would be like buying Amazon for $6 a share in late 2021 in the last crash, after going down 95%. That's what I'm saying. It's that clear.
Someone on that's also bearish on Bitcoin on last week. And I think it's, interesting if we listen to you guys, for those who have Bitcoin holdings or Ethereum, whatever, they're probably looking or listening to this now thinking, what do I do here? Do I get out now and then come back in? But
absolutely. Okay. If something, stock markets and financial assets, 20% corrections happen all the time in bull markets. Occasionally a quick 50% if you have a COVID or something. This is not that. You do not sit through a 96% correction, okay? If you're listening to me, if you see what I see, you wouldn't even think of sitting this out. You do get out now. And I thought Bitcoin would have one more run to 100 grand at the end of this year. Very clear 4-year cycle, by the way, in crypto, 2013, 17, and 21. We're at the end of the year. I say Bitcoin now peaked at 68,000. It's still holding up pretty good. I would be getting out of Bitcoin and looking to buy. My target for Bitcoin, and some things may be better, 4,000 to 7,000. You see that type of number a couple years from now, that's when you buy back. Don't lose 90% of your profits. Take them. All you got to do is get out about 6 months to see if I'm right. And if I am, you're going to be very, very glad you sold out, and you're going to buy so cheap, you're going to kiss the ground.
Let me ask you this. Let's get to some good news. You say by 2024, we should be out of this. So this is the opportunity you speak of, Bitcoin, by the really diluted sectors here. So we come out of this.
there is a pot of gold at the end of the rainbow for you?
Well, yeah. I mean, what did I say? I mean, Amazon went, I mean, the internet stocks went up 600 times after they bottomed in the last crash. So in those sectors, it's a lot. But I mean, just the stock market. Now, the thing is, I do not, this is something I've been saying back for decades. After this baby boom peaks and the millennials come along, the millennials have a shorter boom, and it only takes us back to where we were at the peak of the baby boom in the demographic sector, which is the most fundamental thing. So this is not going to go, you know, I think stocks would be doing, the best I see is that stocks go back to these recent highs by 2037. But if you buy them when they're down at 5,000 and it goes back to 30 or 40,000, then that's incredible. That's an incredible return. But it won't be as strong a boom as the 80s and 90s was, because this generation's not as big. Now, where you will get that is if you go to Southeast Asia and India. China led this last boom in Asia, Southeast Asia and India, because China's already peaked in their demographics. Those, if you want to get astounding returns, crypto, Southeast Asia, and India, those are the three sectors to be in.
Let's wrap with this. I need to ask you about, you mentioned gold briefly before. Why will gold not weather the storm for you, Harry?
Okay, gold correlates with inflation, okay? Gold had its best boom ever in the late 60s and 70s, and then crashed big time after that, okay? Now it came back in this recent period because we've never seen money printing like this. Gold likes to see money printing because gold thinks money printing equals inflation. Well, we're getting a little inflation at the end of this boom here, but we haven't gotten that effect. What money printing did was inflate financial assets. And guess what's in financial assets? Gold. Gold had a bubble just as big as the stock market. It just peaked in 2011 instead of 2007 or now. Okay, so gold typically will do well. If I'm right, we start to see weakness, they're going to say, the economy's weak again, they're going to print more money. But when things go down, like in 2008, gold went up in the early stages of the 2008 crash and then went down 50% in the second half of 2008 when it hit bad. So gold is not the safe haven because we're going into a deflationary couple of years, not inflation. And that's when gold does not be the safe haven. So gold is not the place to be, but I tell you, if you have a little in your portfolio diversified, gold will hold up better than most commodities because of that at least that image that it's somehow a safe haven.
We have so many different viewpoints on this show. That's why I love it.
Okay, bring it home for us, Harry. For all the folks watching, like I said, it's an Outlook 2022. You've made your case for 2022.
To get more specific, yeah. I see 2022 from the highest point in the stock market early on, if not already peaking here in late December. From the highest point to the lowest point will be the worst single year for the stock market in all of history. Now the crash will not be quite as bad as 89, but that next year, since we've held this back so long and bubbled it up and pushed it so far, when it finally breaks, I think 2022 will be the worst single year. So I just say, give me like 3 to 6 months, okay? Just give up a little gains. Now the market's so stretched and they're going to have to taper. You know the market's not going to do great when they're tapering. Just be out, be safe for several months. And if it doesn't start by then, okay, you can jump back in. But I'm just telling you, if you miss this, it will happen so fast, you will not be able to react enough, and you'll react just at the wrong point when it's bottoming, and then it'll get back past the gains, and then it'll go down for a couple of years. That's the scenario. Crash 50% or so, retrace about 40 to 50% of that, and then go dribble down for a couple of years. That was the same thing happened in the Great Depression and the 2000 to 2002 crash led by technology like this.
Harry Dent, thank you so much. Why do I have a feeling that at the holiday parties, you are the life of it? I have that.
As long as I don't talk about the crash, I am. Yeah.
You're that guy. But
hey, look, free newsletter at hsdent.com. Just listen to me for the next 3 to 6 months. You know, if things don't pan out at all, then you can listen to somebody else. But I say I'm the guy to listen to here. I'm just sorry. I am. And I was introduced to, like you said, at a conference as the contrarian's contrarian, because I was at a gold bug conference where everybody thinks they're contrary. And I was contrary to them.
Hilarious. Harry Dent, happy holidays. Happy New Year. Come back on soon, okay?
Sure.
I'll come find you, actually. I'll come find you. And thank you all for watching. We'll have much more for you. So keep staying tuned to our Outlook 2022, only here on StansberryInvestor.com, and sign up for Premier Access at DanielaCambone.com. That's it for me. Thanks for watching.